Good morning, everybody. Excuse me. We'll go ahead and get started here. And this presentation today is brought to you by the North San Diego County Realtors. And my name is Bill Exeter. I'm the CEO of Exeter 1031 Exchange Services and Exeter Trust Company. And today we're talking about unraveling the mystery of 1031 exchanges. And I named that unraveling the mystery of because we get a lot of people who call us and say, I've talked to 3 or 4 people. I got 3 or 4 different answers. I'm really confused. I mean, what really matters, what really qualifies, and what doesn't? And so that's why we thought, we view our job as to really get the information out there so that you know what really matters. We're going to unravel that mystery. But part of that is we're going to really point out why there's all that confusion out there, why you get all these different answers, what really matters, because there's gray areas. So there's very aggressive positions, there's very conservative positions. And this way you could bring more value to your clients, where you could say, look, here's the deal. Here's what works, here's what doesn't work, and there's some gray area. And then the investor can actually make a better informed investment decision based on how they feel about it. Some people are aggressive, some people are very conservative. So that's really our goal. This will be all educational and really discuss the issues involved. We also want to take questions as we go. So just use the Q&A function. I've got that open here in front of me, so I'll see the questions when they pop up. I'll try to either answer it right away, or if I've got a slide coming up that will answer the question, I'll wait till I get to the slide. And then there'll be a little time afterward too. So if I didn't get to any questions, we can get to them at that point. Or if you have any follow-up questions, happy to do that. So that being said, let's go ahead and get started. That's my QR code on the screen there, and you could get our guidebook that you see there. That's about a 30-page guidebook that'll cover everything that we're going to be discussing today. It's a really quick way to kind of get up to speed. It's great for clients who have never done a 1031 exchange before and really want to quickly get an overview as to what really matters, etc. For those who have not worked with us before, Exeter 1031 Exchange Services is a qualified intermediary. We also serve as an exchange accommodation title holder. And what does that mean? Well, the qualified intermediary is kind of a third-party administrator, if you will, where we actually serve as the qualified intermediary. Some people call it the accommodator, the facilitator. So we actually administer the 1031 exchange transactions. We do all the documentation, etc. And in some cases, with the more advanced 1031 exchanges, we have to hold legal title, what the IRS calls park legal title, to certain real estate, certain property. That's where the exchange accommodation title holder comes in. So we also provide that service. We administer all types of 1031 exchanges. We cover all 50 states. We cover the U.S. territories. We're also one of the few qualified intermediaries that covers foreign property 1031 exchanges. So that's the first area I want to point out. A lot of the information you will see in brochures or on the websites out there will say something like you cannot do a foreign property 1031 exchange transaction. And that's not true. What they're really trying to tell you is you cannot sell U.S. property and 1031 exchange into foreign property, or you can't sell foreign property and 1031 exchange into U.S. property. So when you're doing a 1031 exchange, the sale and the purchase has to be all U.S. property, or it has to be all foreign property. But you absolutely can 1031 exchange foreign property that's held for rental or investment into other foreign property that's also held for rental or investment purposes. So that's important. So from a client perspective, they would meet with their tax advisor and crunch the numbers, see what kind of income tax they're going to get hit with on the sale of the foreign property, and then decide whether a 1031 exchange makes sense. The other thing to point out there, excuse me, is the 2017 Tax Act changed the 1031 exchange from the perspective that only real estate qualifies now. Before 2018, you could exchange anything that was held for rental, investment, or business use. So that would include non-real estate, or what they call personal property. So we've used to do exchanges on aircraft, shipping, trucking, machinery, We've done exchanges on livestock, media rights, baseball teams. I mean, we've done exchanges on a lot of interesting things that were held for investment. But today, the only thing that qualifies is real property. And then a little further on us, we're one of the few qualified intermediaries that has any regulatory or government oversight. Our industry does not have a licensing or regulatory body. And we'll talk more about that later. So that's important to know that qualified intermediaries are not licensed, they're not regulated unless they go down a different path. And we'll talk more about that. We've been we've been doing 1031 exchanges now for 20 years. Actually, a week ago was our 20th anniversary. Personally, this is my 40th year doing 1031 exchanges. We have done a lot of exchanges over those years. We've seen a lot of interesting structures and transactions, et cetera. So we're really bullish on advisory and consultative services. I think the best way we can take care of the client is for you and us to get on a phone call with the clients, their attorneys, their CPAs, and really make sure we get a good picture of what's happening. Everybody has a little piece of the pie. We want to make sure that we're doing the right thing for the client. So we also think that if we don't have the answers, we should. So in a lot of cases, the client's question is just a 5-minute question or something. We'll call outside counsel, we'll pay the bill, and we'll get a quick answer for the client. And we offer 24/7 access. So you're working with clients often after hours or on weekends, and you need a question answered, you can get a hold of one of our people 24/7. I mentioned we're regulated. So our regulated entity is Exeter Trust Company. We went down the banking path because we wanted to be regulated. And since our 1031 exchange industry doesn't have any licensing or regulatory body or authority or capability, we spent a couple of years of going through the review and approval process. So we now have our own in-house trust company. It's licensed, regulated, and audited by the Wyoming Division of Banking. So all client funds are held by Exeter Trust Company, which is the regulated entity. We have all the usual fidelity bond coverage, errors and omissions insurance. Because we are a trust company also, we have a financial institution blanket bond, which covers items that most qualified intermediaries probably can't get insurance for, or at least choose not to. And then with that, we were able to roll out other products as well. So we have self-directed IRAs where investors can buy real estate related assets inside their IRA. We do title holding trusts where clients might want to negotiate, acquire, and hold real estate confidentially. If the escrow or title company can't do some kind of a special holding escrow or holdback escrow, we can take a look at that. So we try to be a problem solver. So when your clients have an issue, we can take a look at that and see if we can help. And that was just a quick overview on who we are. So now we're going to jump right into the topic. And again, we're going to point out the areas where there's the confusion and why, et cetera. And then we'll kind of go from there. So I think most people are at least heard of a 1031 exchange transaction, but 1031 exchanges will actually be 103 years old in October. So it's been around for more than a century. Very, very long time, but it's named after the code, section 1031 of the tax code. That's where the name comes from. And it applies to anything that is held for rental, investment, or business use. So any of your clients that are selling a primary residence, a second home, a vacation property, if they don't do something different, those properties probably will not qualify for 1031 exchange treatment because it wasn't held for rental, investment, or business use. But it could. There are ways to change that. There's ways to plan ahead so that it could qualify. So we just need to kind of look at the issue today, look at the fact pattern, decide what we might want to do to help the client get there. But it's a tax deferral strategy. It's all about selling property, deferring the payment of your taxes. So it defers federal taxes, it defers state taxes, which means instead of the client writing a check to the IRS and to the California Franchise Tax Board, which could take away about a third of their profit, it keeps all of the cash, all the equity in their pocket. That makes it easier to trade up in value, to buy larger properties or buy multiple properties or buy more units, et cetera. So that's really what it's designed for. That's what it's all about. So when you're talking to clients, one of the things you can do, and actually I should back up real quick. So when you're talking to clients and they're going to buy or sell real estate, one of the things you could do to protect yourself as an agent is if the client is selling or buying any kind of real estate that is held for rental or investment or business use, send them an email and say, have you spoken to your tax advisor? Or you can certainly refer them to us, have you spoken to Exeter about a 1031 exchange transaction? What we're finding in the last few years is clients will sell a property. They don't talk to anybody. They just sell a property. Then they're going to go and they're going to reinvest in other rental property. Then later, when they go to file their tax return, their accountant says, why didn't you do a 1031 exchange? And the answer is, well, nobody told me. So we're getting more calls from attorneys who say, who should have told them about this? Well, obviously the client should have. The client should have gone and discussed the transaction with their CPA or their tax advisor. They don't. But then they want to point the finger and blame everyone else because they have to pay taxes. And that includes us if we've been talking to them, but more likely it includes you as the agent because they're going to say, why didn't the agent tell me about this? Excuse me. It's not really your job as an agent to tell them. I mean, it's their tax advisor, but they don't go talk to anybody. So to protect yourself, I would just shoot them an email and say, have you talked to anybody about a 1031 exchange? You can shoot them a copy of our guidebook if you want. And that way you can say, I've told you, I gave you the information, I put you in touch with people, however you choose to approach that. And they can't come back and say, why didn't you tell me about it? So it's really a risk mitigation from your perspective. So having said that, the other thing you can tell them is, look, if you're selling rental, investment, or business use property, it's probably going to trigger a taxable gain. It could trigger likely a capital gain tax. It's probably going to trigger a depreciation recapture tax. Depreciation recapture is when you've held property for quite a while as rental or investment property. You depreciate that or write it off on your tax return every year. For residential property, it's 27 and a half years. For commercial property, it's 39 years. If you just sell and cash out and pay taxes, all of that depreciation is added back into the client's tax return the year of sale. And that's what they call depreciation recapture. They're recapturing all of those write-offs they've done. And that's taxed. And that's always a surprise. Clients are always like, I didn't know about that. So it's going to defer federal taxes. It will defer depreciation recapture taxes. It will defer California franchise taxes. It also avoids the Medicare surcharge or the net investment income tax of the 3.8%. Because nothing is taxable at that point. It's deferred everything. So it's all about deferring the taxes. A lot of people call it a tax-free exchange. Be careful with that. It's not tax-free, it's tax-deferred. However, it could become tax-free. We'll explain more about that. So when people call it tax-free, be careful. It could be, but not always. But again, bottom line, it keeps all the money in the investor's pocket, which helps you and the investor buy more property, trade up in value, et cetera. So it's a great tool for you to get additional transactions because every time they're selling real estate and doing a 1031 exchange, there's going to be at least one purchase. And in a lot of cases, clients will buy 2 or 3 properties and they end up trading up where they're selling, say, $1 million and they're buying for $1.5 million or what have you. So it's a great way to kind of build that transaction pool for you. Now, clients will also ask, what's the best way to take advantage of the 1031 exchange? When should I do one? When should I not do one, et cetera? Clients view this as a transaction tool, which it is, but they look at it as I'm selling real estate. I don't want to pay tax on that property sale, so I'm going to do a 1031 exchange. But it's a lot more than that. It's a wealth building tool over time. Because if they, hold the property for, let's say, 5, 7, 10 years, what have you, and they decide, now's the time to sell, it's gone up enough in value, and I think I want to turn around, and if it's a single family, maybe they buy a duplex or a fourplex or buy 3 or 4 single families or what have you. So from their perspective, it's a wealth building tool over time. From your perspective as an agent, it builds a lifelong client who comes back every few years, does another transaction, sells the property you help them buy the first time, and then you buy more properties with them. So it really is win-win for all parties involved. The best way to help the client view this is, and this goes back to the tax deferred versus tax free. It is tax deferred. You keep deferring your taxes over and over and over. That's the big benefit. You keep deferring the taxes, keep the money in your pocket, et cetera. But clients will then say, well, why does it matter? Don't I have to pay the tax eventually? Not necessarily. For example, let's say they just keep exchanging every single time they sell property. They do another exchange, they buy more replacement property, and then at the end of the day, they pass on. They leave the property to their kids, their grandkids, their friends, whoever. Whoever inherits that property from them is going to get a step up in cost basis. That means the capital gain tax completely goes away. The depreciation recapture tax completely goes away, both for federal and state purposes. And then also for the net investment income tax of the 3.8%, they completely avoid that. The reason for that is because the value of the property is included in their estate plan. And because they count it towards the estate tax, or people call it the death tax or inheritance tax, because it's part of that formula, they can't also double tax you and calculate a capital gain tax. So as an example, excuse me, let's assume one of your clients, bought property years ago for $100,000. Maybe 20 years later, it's worth $1 million. So today it's worth $1 million. They pass on. They leave that property to their kids. Their kids inherit the property. The cost basis for the kids is increased or stepped up to $1 million, which is the value at death. So they inherit it at $1 million. They can sell it tomorrow for $1 million. Their cost basis is $1 million. They pay zero taxes. That $1 million will be included in the parent's estate for estate tax purposes, but the vast majority of Americans will never pay estate tax. So it's really a great way to avoid estate tax because they just don't have enough estate value, and defer the capital gain tax because they get that step up in cost basis. So the best way to remind clients of how this all works is they swap until they drop. That's kind of our morbid sense of humor. Okay, having said that, that's kind of the why you would use it, etc. You should also comment that why would you not use it? In some cases, although today it's limited, but in some cases, you have clients who have a loss on the sale of property. Most of the time, you don't want to defer a loss. You want to recognize the loss in the year of sale. So they wouldn't want to do a 1031 exchange in that situation. There are cases where you defer a loss, but that's kind of rare. So they kind of look at that. The other thing is always have them talk to their tax advisor. That helps protect you as well. And the tax advisor can crunch the numbers and let them know exactly what their tax situation is going to be. It's amazing how many times clients have something on their tax return that will offset the gain. It might be a net operating loss carry forward. It might be suspended passive activity losses. There may be some tax credits. There's all sorts of things that could come into play where they could, not pay any taxes or shelter some of the capital gain taxes. So it's always important to do that for many reasons, just to make sure they're doing the right thing. Okay, having said that, let's jump right into the specifics. So there's really three types of 1031 exchange transactions. In our world, and I think it's pretty much the same across the industry, 97% of the transaction volume is forward or regular 1031 exchanges. That means they're selling their current property, their relinquished property first, and then they're going through the exchange process and buying the replacement property second. So that's a big part of the transaction. Obviously, 97% of the transaction volume. The risk with those is you're selling first, you're triggering your capital gain taxes, your depreciation recapture taxes, et cetera. And then you've got your time frames to go reinvest in. We'll talk more about that later. And if you can do that, if they can find property and then identify it and acquire it, it's all tax deferred. But in today's market, as you know, being in the business as you are, it's a tough market out there. The inventory is tight, et cetera, and lending guidelines is tough. The interest rates are tough. So there's a lot of moving parts that make it difficult. If the client sells the real estate, that triggers the gain. If they can't find property, get an accepted offer, and close escrow on it, their exchange fails and it becomes taxable. And that's painful, obviously. So that's the risk with a forward 1031 exchange. Now, the reason most people do those is they're very straightforward. They're much easier to do, except for the market. they're a lot less expensive. There's a lot of reasons why that's why people do those. So a couple of thoughts there to help you when you're working with your clients is the deadlines, which we're going to talk about, only start when the sale of the current property closes escrow. So if we can do things without closing escrow, then we don't trigger those 45 days and the 180 days we're going to talk about. So for example, when you're listing the property, you could say, look, I need a buyer who's going to cooperate. I need a buyer who's going to give us a long-term escrow or options to extend, et cetera. And that gives you and the client more time to go out and find the replacement properties and get those under contract. Or if you and the client find property they want before, you can ask the seller to cooperate. Now, it's still a seller's market, so a lot of sellers aren't willing to cooperate. But if the seller's willing to go under contract and give you a long-term escrow and close whenever you're ready, things like that, options to extend, et cetera, it's all about juggling the timelines and getting everything lined up. But if you could do that, you could still do a regular 1031 exchange, and you could significantly mitigate the risk because you get control over all the closing dates. That's obviously not possible in all the cases. It's very difficult to get all the people to cooperate, especially in today's market. So the next strategy is a reverse 1031 exchange transaction. Reverse exchanges allow the client to go out with you, find the property they want. And at that point, there's no deadline. They haven't started anything. They can take as much time as they want with you to go find property. They can negotiate. They can go under contract. They can open escrow. They can put down earnest money deposits. All of that could be done with no problem because nothing is closed yet. And then with a reverse 1031 exchange, they can actually close on the purchase of their new property first before they've even sold or before they've even listed their current property they're trying to get rid of. Now, that makes it sound great. It's a great way to mitigate the risk. You've got the new property, you close escrow on it. It solves a lot of the problems from a risk perspective. But they're a lot more complicated. There's more costs involved. There's a lot more moving parts and a lot more coordination. So the best way to describe it is in a perfect world with a pure reverse 1031 exchange, it would allow the client to go out, buy the new property, close escrow, take title to it, own it, and then sell the existing property. The IRS doesn't allow that. They can't take title to it. They can't own it, but they can close on it. So the IRS has set up this parking arrangement where we have to set up an LLC just for their transaction. The LLC becomes the buyer. The LLC acquires legal title to the property at closing. That's what the IRS calls parking title. And that triggers their deadlines in which they have to sell their current property. So the beauty here is they've closed escrow. They have the replacement property. Even though it's being held by us, they control it through us. And they don't have to worry about whether they're going to find property or not. And then they have 180 days to sell their current property. And in today's market, depending on the property, that's not usually that difficult as long as it's priced properly. The difficulties are it's a lot more risk to us. We're holding legal title to the property. So you're going to find the fees are quite a bit higher. Most forward exchange fees are probably in the range of $1,000 to $1,500 today. We are $1,295. Reverse exchanges are all over the board. I would say most people who really know reverses, really know what they're doing and have a good quality operation there, you're probably looking at $7,000 to maybe upward of $15,000 for a reverse exchange. And in most cases, we're probably $7,800 to $9,800 for our reverse exchanges, depending on the complexity. So it takes a lot of the risk out because you've got the property lined up, but the costs to do it are more. Also, because we're holding title, if there's a lender involved, the lender is not going to allow us to hold title to the property. So traditional lenders are probably just not going to cooperate. If it's a portfolio lender, like a local community bank, a regional bank that specializes in real estate, they make a loan and keep it in the portfolio. Hard money, private money lenders, credit unions, et cetera. Those type of lenders typically look at it. So it could be an option to go down that path. So that's really the two more important or more common types. 97% would be the regular exchange, 3% are the reverse exchanges. The improvement exchanges, you don't see a whole lot of these because of that 180-day window. But to break it down quickly, the improvement exchange means the client is selling one property, or I shouldn't say one, they're selling one or multiple properties. They take the proceeds, they go buy another property, they have proceeds from the sale left over, and they're using those cash proceeds to then make capital improvements to the new property. So to do that, it's just like a reverse exchange. We have to take title to the property. So we set up an LLC to hold title to the new replacement property. And then the client would have the rest of the 180-day window to make the capital improvements. Well, as you know, we're all in California here. So getting permits in 6 months is probably impossible. So improvement exchanges are very difficult. They can be done. If it's a ground up project, it's probably just not going to happen. But we do a couple of those every month, so it is possible. So those are the three structures. Again, 97% are forward exchanges, 3% are reverse exchanges, and every now and then you see one of those improvement exchanges. Okay, I'm going to walk into the mechanical steps now of how you actually structure the 1031 exchange. So this one is important in terms of getting the 1031 exchange set up before closing occurs. We literally get calls every single week where people say, well, I closed yesterday, last week, last month, what have you. I either just found out about it or I just decided to do a 1031 exchange. At that point, it's too late. And here's why. When you set up a 1031 exchange, the purchase and sale agreement is assigned to the qualified intermediary. So the qualified intermediary steps into the shoes of the seller, becomes the seller. The closing occurs and the funds are wired to the qualified intermediary. That's what defers the taxes. If the 1031 exchange is not set up prior to closing and it closes, the client has the right to receive the funds. Even if the client told escrow, don't disperse the money, I'm going to do a 1031 exchange, it doesn't matter because the minute it closes, the client has the right to receive the funds. So it's taxable. So it's important that if they're again selling rental, investment, or business use properties or buying, make sure you send that email. Say, have you talked to somebody about a 1031 exchange, just to protect you in case they come back later. It is amazing how many times they say, no, I don't want to do that. And the day after closing, they say, you know what, I think I should have done that. Well, it's too late. The qualified intermediary really does three things. They do the legal documents to structure the 1031 exchange. They're going to either hold cash proceeds if it's a regular 1031 exchange, or they're going to hold legal title to property if it's a reverse or improvement 1031 exchange. And then I think the most important thing is they should be more consultative in their capacity, in their roles. They work with you, the client, and the legal and tax advisors to walk through the process and make sure the client's doing what is best for them. All too often, unfortunately, qualified intermediaries are just processors. They just process the paperwork and that's it. And unfortunately, that creates a taxable event because they just don't know what they should know, and they make mistakes and things happen. In fact, most of the issues we see is qualified intermediaries that don't catch something that was easy to catch, and then the transaction closes and it becomes a permanent taxable event at that point for different reasons. So very important, you've got a qualified intermediary that is willing to review all the documents and try to catch errors before they happen. So that brings us to the next slide, which is, what do you look for when you're trying to select a qualified intermediary? And one of the most important things is, how do you safeguard the funds? So I mentioned regulation before. Qualified intermediaries typically administer lots of 1031 exchanges. So a lot of your smaller qualified intermediaries might administer 10 or 15 transactions a month. You get us, we're in the mid-market, so there's about 15 to 20 of us that are kind of in the middle market. They could be anywhere from 1 to 300 or 400 1031 exchanges per month. And then you get the big guys who are doing thousands of exchanges every month. So they're obviously holding lots of money for lots of clients. And that way it's critical that these funds are protected. So how do you do that? Well, again, as I indicated, our industry has no licensing or regulatory body or capability. So the QIs could basically do anything they want to do, and there's nobody looking over their shoulder. We wanted to be regulated. I gave that story. We went down that path of getting reviewed and approved. We have our own trust company. So Exeter Trust Company is the regulated entity. Most of the qualified intermediaries that I have seen fail over the years would have been prevented had there been regulatory oversight. So that's why it's critical. To me, that is the most important thing that you can look for in a qualified intermediary is, are you regulated? Now, if you ask that question, a lot of them will say, oh, yes, we're regulated, but they're not. They're owned by a title company or owned by somebody like that, but they're not directly regulated. The funds are not being reviewed. The transactions are not being audited by a regulatory agent, regulatory auditor. It's critical that the transactions are actually being audited by the regulatory body. Next, people talk about bonding and insurance. That's critical because stuff happens. So fidelity bond is crime insurance, theft of funds, misappropriation, embezzlement, things like that. Errors and omissions is probably the most critical insurance to have because it's more likely that we're human, we're going to make a mistake. And when we do, are you as the client covered? So most important, you want to make sure they have errors and omissions insurance. It's amazing how many QIs do not have E&O insurance. And then, of course, we have the financial institution blanket bond coverage because we are a financial institution. The final one is qualified trust accounts. It's a long story, but for those of you who have been around as long as I have, you'll be aware of or know of Land America Title. Land America failed in the 2008 recession, and their QI, their qualified intermediary, actually caused the failure. Now, they invested in auction rate securities, which are not bad investments, but they're not prudent for 1031 exchange funds. But they did it to get a higher yield, which makes a bigger profit for them. And then, of course, the 2008 recession hit, the auction rate securities market froze. It's a long story, but they ended up failing, ended up in bankruptcy court. The judge ruled the funds were not client funds. They were corporate funds because they were held in their corporate name. Funds can be held in a corporate name. It qualifies for 1031 exchange treatment as long as it's the qualified intermediary holding the funds. But in a bankruptcy, they become corporate funds. So the way to avoid that is to make sure that client funds are held in a qualified trust account or a qualified escrow account. That's one of the most important reasons we set up Exeter Trust Company, so we can clearly show Exeter 1031 Exchange Services is the qualified intermediary, but never holds the client funds. Exeter Trust Company is a separate entity. It's a regulated entity, and it holds the client funds. And each client gets a separate, segregated, qualified trust account. That is critical in the event something happens to the qualified intermediary. Okay, next slide is qualified use. This is probably the most important slide. It's also where there's the most misinformation out there. I shouldn't necessarily say misinformation. The most opinions, which with a lot of different opinions. So probably the biggest area we see here where people are confused is, how long do I really have to hold title to the property? We'll get people who call up and say, I've been told that I don't qualify for a 1031 exchange because I didn't hold it for a year and a day, 18 months, 24 months. The question is, well, what is it? How long do I have to hold title? Is it a year? Is it 2 years? What is it? The answer is it depends. The tax code, the regulations, and rulings have no holding period required. So contrary to what you've seen out there, there is no holding period. There's nothing that says you have to hold title for at least a year and a day or 2 years. Those are opinions, and that's all they are. The real important issue, what really matters, is the intent. If the client can prove they intended to sell and buy properties that were held for rental, investment, or business use, they will qualify regardless of how long they held title to the property. So that's really the issue. So first off, the properties you're selling, the properties you're buying through the 1031 exchange have to be held for qualified use. That means it has to be held for rental. So rental properties produce income. They're rented out, they're leased out, whatever it might be, that's producing income. But a lot of what you see out there says it has to be held as rental property. That is not true. It doesn't have to be held for rental purposes. You could buy property and hold it for capital appreciation. That's held for investment. It doesn't have to produce cash flow. So you may have a client who sells a single family home and buys dirt and just holds the vacant dirt, the vacant lot, for capital appreciation. And then 5 years later, it hits a certain price point and they sell it and they do another 1031 exchange. So it doesn't have to produce cash flow. It could be held for investment or capital appreciation. Or they could buy property and they actually use that in their trade or their business, whatever it might be. Maybe they buy a little retail shop, a little office, commercial office building, a factory or industrial facility, warehouse, etc. All of that's going to be considered held for business use. So those are the three categories. As long as they fall into those three categories, it qualifies as qualified use property. So let's go back to intent. And let me give you a couple of examples. First of all, taxpayers who are in the business to buy property, do something to the property, a developer, contractor, builder, rehabber, flipper, condo conversion specialist, they buy, they do something to the property, and they turn around and sell it. They're not holding for investment as defined for 1031 exchange purposes. They're really holding for sale. It's really real estate held as inventory in their business. So if they're buying real estate with the intent to do something and sell it, they're holding for sale. They're not holding for investment purposes. So it won't qualify for 1031 exchange treatment. If they buy the property and then hold it as rental, investment, or business use, it will qualify. If they buy the property and do something to the property, rehab it, develop it, what have you, and hold it as rental or investment property, it will qualify. But if they do something and then hold it for sale and flip it, it doesn't qualify. So let me give you some examples to show you what that really means. There are two tax court cases. Both were developers, both bought dirt, both intended to build single-family homes and then sell, like developers typically do. In these two cases, which are completely unrelated, they both bought dirt, they both held it. Neither one built anything. One held the dirt for 12 years, one held the dirt for 20 years. Both ended up selling the dirt, both did 1031 exchanges, and both got audited, and both were disallowed because they held the property for sale. All those years, 12 and 20 years, they held the property with the intent to build and sell. So their intent was to hold for sale. And that was the reason their exchanges were disqualified. However, had they changed their intent, so halfway through that process, maybe the real estate market has changed. Maybe their business model has changed. COVID-19 changed a lot of things for a lot of people. And if they had said, you know what, we're no longer going to hold these for development, we're now going to hold them for investment, we're going to wait till they get to a certain price point, and then we're going to sell, then they would have qualified for 1031 exchange treatment. And it's very easy to document the change. You change the way you report it on your tax return. You report it on Schedule E as property held for investment, not development. So property held for investment. On financial statements, loan applications, you report it as property held for investment. Emails back and forth between the client and you, the tax advisor, the legal advisor, us. They'll ask questions. How should I depreciate this property now that I'm going to hold it for investment? How do I do this? How do I do that? All of this helps prove the intent has changed to held for investment, and their exchanges would have qualified. On the flip side, we had one of our clients here, actually in San Diego, do an exchange, bought a condo in Coronado Island, did not read the CC&Rs until after closing, obviously not a good idea. Quickly found out it had to be owner occupied, could not be held for rental, quickly sold, did another exchange, bought a property that he could rent out. He was audited by the California Franchise Tax Board, which is a lot worse than the IRS. And they actually allowed his 1031 exchange to qualify, even though he had only held the property for about a month and a half, because he could prove his intent was to hold for rental purposes, but there was a business reason why he couldn't. So again, all boils down to intent. What can they prove during an audit? That's the most important part. So the holding period is just that. It's a holding period. It really helps prove intent. The longer you hold the property for rental or investment or business use, the easier it is to prove intent to hold. The shorter the period, the more difficult it is to prove intent. So when people say you don't qualify because you didn't hold it for 12, 18, 24 months, whatever, those are opinions. It all depends on the fact pattern. So when people ask me, well, what do you think? What do you recommend? If it's a plain vanilla transaction, you're not pushing the envelope, you're selling rental property that was, let's say, held for 12 months, and you're buying rental property through the 1031 exchange that's going to be held for 12 months. It's a plain vanilla transaction. 12 months should be fine. 12 months documents that you had the intent to hold it for rental. 12 months straddles 2 tax periods, 2 tax returns. So you're going to have 2 tax returns reporting it as rental property. Should be fine. If they're taking risks, if they're pushing the envelope, maybe they are buying property that at some point they might want to live in it. They're going to convert it from rental to a primary residence. Well, I'd probably rent it longer. I'd probably do at least 18 months. I try to stretch it to 24 months. I would try to do 3 tax periods in there. The longer you have it held as rental property, the easier it is to demonstrate your intent was to hold for rental purposes, and then your intent changed. So that's really what the holding period is all about. Next is like-kind property. Still lots of misinformation out there about like-kind, or again, not necessarily misinformation, but opinions. With like-kind property, it's very simple. It means you're selling real estate, you have to buy real estate. That's all it means. So it's not condo for condo. It is not apartment for apartment or land for land. It is real estate for real estate. So as long as they're selling real estate and buying real estate, it qualifies for a like-kind treatment. So the real issue is it qualified use? Does it qualify as held for rental, investment, or business use? The only exception here is, again, like I pointed out at the beginning, if you're selling foreign property, you have to reinvest in rental property. If you're selling U.S. property, you have to reinvest in U.S. property. And personal property, meaning non-real estate, doesn't qualify anymore, but any kind of real estate qualifies. So this is a quick list of like-kind property, and you see it includes things you wouldn't even think of including, which is air rights and water rights and mineral rights and oil and gas investments. Fractional ownership qualifies. So if you buy a tenant common interest like 10% in a property, that qualifies. Delaware statutory trusts, or what they call DSTs, qualify. You're buying a fractional interest in a very large property. Things you wouldn't even think of also qualify. We've done exchanges on vineyards and timberland and billboards and cell site towers. And so anything that is considered real estate will satisfy the like-kind requirement. That's the most important part. Non-like-kind property is just as important to talk about. So with non-like-kind property, first of all, anything is personal use. Your primary residence, second home, vacation property, etc. That's not going to qualify. It's not held for investment. It's held for personal use. There's a lot of gray areas here because second homes and vacation properties can be used for personal use and rented out. So the question is, what is it really? And obviously, the more personal use, the more risk you have that it's not investment property. If you want to 1031 exchange, one of the safest things to do is stop all personal use, rent it as much as you can for a year or two. I'd probably go closer to 2 years, just an opinion, to be very conservative and easily demonstrate your intent has changed to hold for investment purposes. This one gets a little more complicated. Investors often hold property inside of an entity. The most common is an LLC. The question is, who is the real taxpayer? So in a lot of cases, they get investors together or family members together. They set up an LLC. So there's 3 or 4 or 5 members in that LLC. It's treated as a partnership for tax purposes, typically. And that means each of those parties becomes a partner in the partnership. The question is, who's the taxpayer? Not the individuals. The individuals are just partners. The entity itself is the taxpayer. The entity owns the real estate. The entity files a partnership tax return. It's a separate entity. So when they go to sell, if the partnership stays together and the partnership does a 1031 exchange, the partnership reinvests in like-kind property, very easy, very clean. The partnership has done the entire transaction. But in a lot of cases, that's not the case. The partnership wants to break up. Individual members or partners want to go different directions. That's where it gets confusing. That's where it gets very complicated because they're not selling real estate. They're getting a cash distribution from the partnership. That doesn't qualify for 1031 exchange treatment, but it can. We have to look at the entity. We have to look at the partners. We have to look at what their goals and objectives are. Who wants to exchange together, who doesn't, who wants to cash out and pay the tax, who doesn't, et cetera, and then try to find a way to fix the problem. So this is where, in a lot of cases, we're going to jump on a conference call with you, the client, their tax advisor, their legal advisor, and then everybody's got a little piece of the pie to contribute and figure out exactly what the best solution is. There's lots of ways to solve this, but it takes time to solve the problem. Okay, 1031 exchange deadlines. I think lots of you probably already know this. You hear it all the time. When the first transaction closes, it's going to trigger your 45 calendar day ID period. You have to identify the properties you're going to buy, or in a reverse exchange, what you're going to sell within 45 days after the closing. That's what creates the biggest challenges in today's market. 45 days moves very quickly, but you've got 45 days to identify what you're going to buy in most cases. So again, we talked about strategies for going under contract but not close, long-term closing or escrow, options to extend, things like that. That helps kind of coordinate all the moving parts to take advantage of this. But deadline is 45 calendar days to identify what you're going to acquire. Then you have an additional 135 days after the 45-day window to complete the 1031 exchange, for a total of 180 days. You've got 45 days to identify, another 135 days to complete the exchange, for a total of 180 calendar days. The 180 days is usually not too bad unless it's a large, complicated commercial property. It's the 45 days that presents the challenges. There's also one exception, that is anytime you close on a sale of property between October 17th and December 31st, your 180-day window lands after April 15th, which is the due date for tax returns with individuals. So you have to keep that in mind and make sure that if you haven't finished your exchange by the time April 15th rolls around, file for an extension of time to file your tax return, complete the 1031 exchange, and then file your tax return. You'll have the full 180 days, but you never have more than 180 days. And one of the questions we get a lot of is, can you get an extension on the 45 or the 180-day exchange deadlines? And the answer is no. Over the years, we have had clients attempt to get an extension for all sorts of reasons. From medical, we had a client who was in ICU after having a heart attack and was unconscious or in a coma. His attorney wrote for an extension. The IRS turned it down because the IRS does not have authority to grant those extensions. It would take an act of Congress to do that because it's actually built right into the tax code. So keep that in mind. It's hard coded. It's 45 days, 180 days. That is what it is. Identification. People ask, well, what does that mean? What do we have to do? Identification is actually fairly easy. So going back to the hard part is finding the property and getting it lined up and ready to go, and then identifying it during the 45 days. The actual identification process is relatively easy. Most qualified intermediaries will provide you with some kind of an identification form. That's where you want to be careful, because the identification forms can really work to the client's advantage when things don't go quite as planned. Most qualified intermediaries provide a very basic identification form. It'll work, it qualifies, but it doesn't help the client when difficulties occur. So that's a whole other topic that'll take a long time to talk about. But you want to make sure you're working with a qualified intermediary who's got a really extensive identification form that helps the client when things don't go right. So first of all, to identify, we provide you with a form. All the client has to do is fill it out, sign it, scan it, email it back to us. That's considered identification. Simple as that. Most clients use the 3 property rule because they're going to sell an asset worth, let's say, $1 million, and they're probably going to identify 3 assets, each of which are worth $1 million or more. So $1.2 million, $1.5 million, $2 million, whatever. Most clients trade up in value a little bit. And they identify 3 with the intent to buy 1. The second and the third properties are your backup properties. Now that works great in a normal market. This is not a normal market, as you know. So the 3 property rules was really designed, or is designed, to identify 3 with the intent to buy 1. The second, third are your backup. If the first one falls out of escrow for whatever reason, you go to your second and your third and you buy one of those. In today's market, the second and third are probably long gone. So the 3 property rule doesn't work as well as it should today. So you really need to get as far along in the purchase process as you can to mitigate the risk. Now, some clients are selling a larger asset and they don't want to buy a greater value property. They want to diversify and buy a bunch of smaller properties. So the 3 property rule probably won't work for them. They'll look at the 200% rule. And this rule is 200% of the fair market value of the relinquished property they sold. So I'll give a specific example. We had a client a couple of years ago sold a $4 million property in Orange County, and wanted to buy as many single-family residential properties in Tennessee as possible. So the client obviously sold the $4 million asset. 200% would be $8 million. So $8 million was the limit. They can go to Tennessee and identify as many single-family properties as they want, up to $8 million in total value. So they actually identified 56 properties in Tennessee. I know, crazy, right? But in this case, they identified 56. Doesn't mean you're going to buy 56. Just means you've identified 56. Now you can go through due diligence and choose which ones you actually want to buy. In his case, or their case, all they have to acquire is about 3.8, 3.9 million in value. I'll get more specific on that in a minute. As long as they trade up to that value, they've reinvested everything and they defer all their taxes. So they ended up buying 20 some of those single family residential properties, not the 56. But that's an example of how that 200% rule can kick in. In other cases, which is somewhat rare, but you might be in a position where you identify a lot of properties. We had a lady who sold one and identified 40 single family properties. So we called her and said, look, it's way over 3 and it's also way over 200%. The only way this is going to qualify is if you actually close on the purchase of 95% of the value, not the properties, but the value, which means in her case, she'd probably have to acquire about 39 of those properties to meet the requirement. She said, in this case, not a problem. I have one seller. It's a portfolio purchase. It's one contract, one closing. I'm either buying 100% or 0. So she ended up closing on 100%, which means she bought more than 95% of the value that she identified. So that qualifies. The identification does have to be unambiguous. You can't say the condo complex at the corner of 8th and 10th or something like that. It's going to have to be unit number 1. So it has to be very specific. You can't, if it's too ambiguous, where you can't really tell what specific property you identified, it'll be disallowed under audit. Reinvestment requirements. So going back to that, let's say in that example I used, the investor sold a $4 million asset. How much do they have to reinvest to defer all of their taxes? Now, in most cases, clients are trading up in value, so it's not really an issue. But some of your clients will say, I want to stay as close as I can to what I sold. I don't want to have to put more money in. I don't want to have to get more debt. So the exact formula is you take the sale price, $4 million, subtract your routine selling expenses. So not everything on your settlement statement, just your routine selling expenses. That's going to be your broker's commission, title, escrow, documentary transfer tax, recording fees, things like that. You subtract those. So a $4 million sale, your net sale price after you subtract those costs is probably about 3.8 million, give or take. Notice we did not subtract debt. Mortgage or debt has no bearing on the taxable gain or anything like that. So you take sale price minus just your routine selling expenses. That is it. You can't deduct anything where they spent to get the property ready for sale. That's not a selling expense. That's repairs and maintenance or capital expenditure. You could always put more cash into the property or into the transaction, but if you pull cash out, it's a partial exchange. It's probably going to be taxable. Depends, obviously, the CPA needs to crunch the numbers and see what happens. So that brings us to the next one, which is a lot of the things you see out there or read out there say you have to trade equal or up in value. You have to reinvest all your equity or cash. You have to replace your debt. Well, for the most part, that's true because most people are trying to defer all of their taxes, but it's not completely true. So you can do a partial 1031 exchange, and that does not hurt the 1031, but it does mean you're going to pay some taxes, probably. So as an example, let's say you sell $1 million asset and the client tells you, you know what, I'm really cash short. I'm in trouble, whatever. Some people just have zero cash. It's the old adage, real estate rich, cash poor. So they say, I need $50,000, I need $100,000, whatever it might be. You could sell for $1 million and you could reinvest for, say, 800, 850, 900, whatever, and you pull the difference out as cash. Again, it does not hurt the 1031 exchange. It is a partial 1031 exchange. You will pay tax probably on whatever cash is pulled out because you're trading down in value, or you got a larger loan which resulted in cash that was not reinvested. Either way, it's cash left over. That's taxable, but it doesn't hurt the 1031 exchange. The rest of the gain will be tax deferred, but whatever you don't reinvest is going to be taxable. But again, you can also talk to your tax advisor. You may have net operating loss carry forwards, suspended passive activity losses, etc., that would offset those gains. So it may not be taxable. But just keep in mind, partial exchanges are absolutely okay. And this is our last slide, and then I'll take any follow-up questions that you might have. This is one of my favorite tax planning strategies. That's why I put it in here. It also could be a great farming tool for you guys. What it boils down to is you've got clients who bought a property as a primary residence. They've owned it for years and years and years, and the capital gain is huge. And they go to sell it, and they've got a problem. Or you're calling on them and they say, I can't sell, I won't list because I have a huge capital gain. And if I do, I'm going to get killed. So if it's your primary residence, as you know, if it's a married couple and you sell it and you've lived in it for at least 2 out of the last 5 years, you get $500,000 in gain tax-free. But what if your gain is huge? Any gain above the $500,000 will be taxable. So I'm going to use a client as a specific example. We had a client who was in La Jolla, husband and wife, bought property, lived in it for 42 years as a primary residence, wanted to sell because they're having health issues, wanted to go back east with their family. Their gain was $8 million. So they would have gotten $500,000 tax-free. They would have gotten taxed on $7.5 million, and that would have hurt. That's a big number. So they were introduced to us. We said, you know what? The IRS has a ruling out where you can convert your property to investment property. So convert it to investment property, go back east with your family, then you're done. You're back east with your family. That's what you want to accomplish. You've converted it to rental property. I would say rent it for 2 years to prove you intended to convert to rental. And then when you're done with the 2-year rental period, sell it. And at that point, you can still say you've lived in it for 2 out of the last 5 years. So they still got the $500,000 tax-free exclusion. And they also have rented it now for 2 years. So now they qualify for 1031 exchange treatment. So the other $7.5 million in gain can be deferred through the 1031 exchange. So that's exactly what they did. They moved back east with their family. They rented the property out as rental property for a 2-year period. Then they kicked the tenants out, sold the property. And as long as you sell within that next 1 year and they close escrow within that 1 year before the 3-year window's up, they get both. They got $500,000 tax-free, deferred the taxes on the other $7.5 million, and everybody was happy. It's a win-win situation. The key is the day they move out and convert it to investment property starts a 3-year window. After 3 years, you can't say you've lived in it for 2 out of the last 5 years again. Then you lose that $500,000 tax-free exclusion. So it's very important to follow those timelines, but it's a great tax planning tool. And when you're farming out there for clients, when you're talking to clients or maybe even doing a specific mailer on that topic, you can say, look, if you've got a huge gain, here is a solution. It takes a couple of years to get there, but it's a great way to plan for this tax problem. And it's a great way for you to kind of put the idea out there and get some more business. The final area is you've got clients sometimes who are selling lots of properties and buying lots of properties, and they're trying to put it all together in one 1031 exchange. And a lot of times, especially in today's market, it may not work. Had a conversation this morning where the client is selling 7 single-family residential properties and trying to buy one larger property. It's a multifamily property. Well, in the market, you just don't know. He's got 2 of the single families that he thinks are in a crappy market. That's a new professional term, by the way, crappy market. And he's just not sure how fast those are going to sell. There's 2 that have deferred maintenance, et cetera, things like that. So it could be a scenario where he lists them all for sale. 2 or 3 or 4 might sell relatively close together. Then he's going to have to close on the purchase of his new property that he's identified, and then close on, say, 2 or 3 sales. So it's some sales close, then the purchase, then some more sales. In that case, we can structure 2 separate 1031 exchanges effectively, where you're selling property as part of a regular forward 1031 exchange. When we get to the purchase of the replacement property, we then bifurcate that or split it. And some of the value is allocated to the forward exchange. We wrap that up. And some of the value is allocated to the reverse, a brand new reverse exchange. Now he's got another 45 days to identify the other properties he's still trying to sell. And he's got a new 180-day window in which to sell those other properties. So those get complicated, but just wanted to throw that out there. It's possible to put different 1031 exchanges together to solve timing problems. We just have to look at the fact pattern and see what we can do. And that is a quick whirlwind tour. I hope we did a good job of unraveling the mystery of 1031 exchange transactions. If there's any follow-up questions, I'd be happy to take those now, and be happy to chat. If nothing now, you're always welcome to call us and just kind of brainstorm on what might be a strategy that would help you and your clients. Okay, I don't see any questions. So again, thank you for participating today. And again, this presentation was brought to you by the North San Diego County Realtors, and happy to chat. Oh, there's one quick question. No questions, but thank you. Learned a lot. Appreciate that. Thank you. So anytime you want to brainstorm, I'm happy to do so. Happy to chat, jump on a call, etc. We don't have any one size fits all kind of thing. We will take your direction, whatever you think is appropriate for the client, whether it be we just talk to them or we do a conference call with you, the client. Preferably if we get their tax and legal advisors on the phone, that's better because it helps protect you and us and really make sure the client's doing what's best for them. But we'll take your lead in terms of how you think it should be approached and kind of go from there. So our contact information is on the screen. You can reach out, ask for Hiba Exeter. Hiba, it's H-I-B as in boy, A as in apple. She's the business development officer for the West Coast and can get me in touch with you if it's a complicated matter, et cetera, or to get started, she can get you going there. So happy to help however we can. Thank you so much and have a great day.